What if I told you that your country's economic growth depends on something that can never be fully repaid? What if prosperity itself, rising markets, expanding businesses, higher asset prices only survives as long as debt keeps growing? We're told debt is dangerous. We're told to avoid it, pay it off, live within your means. Yet somehow the global economy, governments, corporations, households sits on over $300 trillion in total debt. And instead of collapsing under it, the system demands more. So here's the mystery. If debt is so bad, why does modern prosperity collapse without it? To understand this, we have to go back to when money stopped being money and quietly became credit. For most of human history, money was a commodity. Gold, silver, something scarce that couldn't be created on command. Then came banks. It's not just vaults for safekeeping, but a system that discovered something powerful. You don't need to lend out gold. You can lend out claims to gold. This is where fractional reserve banking changed everything. Banks realized they could issue more paper claims than the gold they actually held, because not everyone withdraws at once. This was the first shift. Money was no longer a thing. It was a promise to repay. Every time a bank issued a loan, new money entered the system not from savings, but from debt. This is critical. Modern money isn't created by printing. It's created when someone borrows. No borrowing, no new money. That means growth itself began depending on expanding credit. But this system still had one constraint: gold. And that constraint would eventually disappear. In 1971, a quiet decision reshaped the global financial system. The United States ended the gold convertibility of the dollar. Money was no longer tied to a scarce physical asset. It became fiat-backed by government authority and trust. That single move removed the final brake on credit expansion. From that point on, money creation no longer required gold reserves. It required borrowers. Borrowers became the engine of growth. Governments could run deficits. Corporations could expand using cheap credit. Consumers could buy homes, cars, lifestyles on future income. GDP growth accelerated. Asset prices soared. Financial markets deepened. But underneath it all was a simple equation. More debt equals more money, which equals more spending, which equals more growth. And once economies adjusted to that rhythm, something dangerous happened. Growth without expanding debt became almost impossible. Debt works beautifully until it doesn't. In the early stages, borrowing funds, productivity, factories, infrastructure, innovation. Over time, something shifts. Debt stops funding production and starts funding asset inflation. Instead of building factories, credit inflates housing prices. Instead of increasing output, it boosts stock valuations. And eventually, debt grows faster than real economic output. That's when the system becomes fragile. We saw this pattern clearly before the 2008 financial crisis. Household debt surged. Mortgage lending exploded. Financial institutions multiplied risk through leverage. When housing prices stalled, the illusion cracked. Because here's the truth. When debt stops expanding, money supply growth slows. And money growth slows, spending contracts. Now, spending contracts, asset prices fall, and falling asset prices trigger panic. So what did policymakers do? They didn't let debt shrink. They made it bigger. After 2008, central banks slashed interest rates to near zero. They launched quantitative easing purchasing bonds with newly created reserves. The goal wasn't to eliminate debt, it was to sustain it. Because allowing widespread deleveraging would have meant deflation, bankruptcies, and collapsing markets. So instead of cleansing the system, they stabilized it. At the cost of expanding it further, public debt ballooned. Corporate borrowing surged. Financial markets became dependent on low rates. Then came 2020. Governments injected trillions in stimulus. Debt didn't pause. It accelerated. Now global debt sits at levels unimaginable decades ago. And here's the paradox. The more debt accumulates, the harder it becomes to stop borrowing, because interest payments themselves require growth. And growth requires more credit. It's not just a cycle, it's a dependency. You might think the solution is obvious. Reduce debt, balance budgets, encourage savings. But here's the catch. If everyone simultaneously pays down debt, money disappears from the system. Remember, loans create deposits. When loans are repaid, deposits shrink. It means less liquidity, less spending, and lower asset prices. In a highly leveraged system, large-scale deleveraging can trigger a recession or depression. This is why governments rarely choose austerity during downturns. They choose stimulus, because contraction is politically and socially painful. So the system favors expansion. If long-term risks grow, it's not necessarily malicious, it's structural. Prosperity became dependent on perpetual borrowing because the monetary system itself is debt-based. Look around today: rising government deficits, high corporate leverage, consumers relying on credit to maintain living standards. At the same time, asset markets remain sensitive to interest rate changes. When rates rise, markets wobble. When borrowing slows, growth weakens. Central banks face a dilemma: fight inflation, aggressively risking recession, or support growth risking more debt accumulation. This tension isn't temporary, it's built into the system. We've seen this pattern before. The late 1990s tech bubble, fueled by credit expansion. The 2000s housing boom, fueled by leverage. The post-2020 stimulus fueling asset surges. Each time, growth depends on credit. Each time, excess leads to a correction. And each time policymakers respond with more liquidity, the scale grows larger. The timeline shortens, the dependency deepens. So is perpetual borrowing sustainable? History suggests debt can grow for long periods, expand and productivity rises. But when debt grows faster than real output indefinitely, strain builds, servicing costs rise. Policy flexibility shrinks. Confidence becomes fragile. The system doesn't collapse simply because debt is high. It collapses when trust breaks. And trust is the true foundation of fiat money. So here are 3 clear takeaways. First, modern money is debt-based. Most currency enters circulation through borrowing. Without credit expansion, growth slows. Second, prosperity in this system relies on confidence. As long as people trust governments, banks, and institutions, debt can roll forward. And third, the risk isn't debt alone, it's imbalance. Debt funding productive investment strengthens economies. Debt funding speculation weakens them. We've built a system where paying off all debt would shrink the economy, and expanding it indefinitely increases vulnerability. That's the paradox. Prosperity depends on borrowing, but borrowing carries limits. The real question isn't whether debt will continue growing. It's whether growth can eventually outpace it, because if that balance breaks, the adjustment won't be subtle. It never is. If this changed how you see money, debt, or growth, don't just scroll away. Subscribe for deeper breakdowns on the hidden mechanics of financial systems, economic paradoxes, and the forces shaping global power. Because the more you understand the system, the harder it becomes to be controlled by it.